Warren Buffett invested in Coca-Cola in 1988. And back then, Coca-Cola was still considered a blue chip. So the misconception is that people think that, hey, Coca-Cola as a blue chip, it can't really fly anymore. But since then, it has compounded huge returns for Berkshire Hathaway and it has set in the top 10 position of the company. And on top of that, Coca-Cola's yield, or Warren Buffett's yield on his purchase of Coca-Cola in 1988 now sits at more than 50%.
Today's episode is brought to you by World First. They are an all-in-one business account that will fuel your business growth worldwide. For all you coconuts thinking of doing your own e-commerce shop, they have a fully thought-through end-to-end process that can allow you to pay 100 over currencies and collect 20 over currencies. Of course, all the major currencies are applied, like the US dollar, the yuan, the ringgit, and many more. Check them out in the link below. Later in the podcast, I will share with you their latest product. Meanwhile, welcome back. Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today is an interesting episode because recently there's been a lot of discussion about how the world is going crazy. So the Singapore stock market starts to become this like safe haven that people are looking at. So my producer say, let's talk a little bit about blue chips. So I'm joined with Willie from Dividend Titan. If they don't know you, you want to introduce yourself. Although you always come. So I don't know why they don't know you. But yes, please.
Hello, my name is Willie and I write a financial blog called dividendtitan.com. So I talk about different stock ideas. I invest mainly for dividends, but I think I would like to call myself more of a value investor.
So is the Singapore stock market good?
For me, it's always good.
What a blanket statement, right? What a blanket statement.
For me, Singapore is always a large part in my portfolio.
Okay.
So it's something which I always gun for. And, as a Singaporean...
Oh, don't give me that.
I cannot shy away from Singapore.
Support local. Local.
Don't give me that. Support local. Okay, we'll go there. Okay. Tariq first, we'll go there. And we're joined with Chuin, Ting and Kelwin. For our audience that don't know you would like to introduce yourself?
Hi, I'm Chuin Ting. I'm CEO and CIO of MoneyOwl. So we are a social enterprise and financial advisory firm under Temasek Trust.
Help us elaborate a bit.
I think we are quite mission focused. We've always been mission focused, and our mission is just to enable better financial security for the many. Not just affluent few, and through life's journey in a kind of a holistic way. Yeah. So investing, of course, is part of the solutions that are very important for building that financial muscle. Financial planning muscle. So what we are not doing is that we don't do any direct selling. So we are like kind of professional advisors who we can talk about products, but we don't sell any.
It's like career counselors. Yes, and Kelvin, want to introduce us?
Hi, I'm Kelwin. Little stressed, I'm sitting among giants. I'm the co-founder of the financial blog also, Singapore Humble Stock. I'm a remiser come wealth manager. So we kind of hit all areas, doing investing and also doing personal protection.
So maybe we start off a blanket question, right? Like, what is your take on blue chip stocks in Singapore? Any like blanket statements that will kind of help our audience start this discussion, Yeah, anybody can take a jab.
I think now everyone talks about global investing and investing everywhere, right? So to put things in context, blue chip can mean different things in different places. So we're talking about blue chips in Singapore. You're looking at companies which are roughly about $1 to $2 billion of market capitalization, market value and above. Whereas if you're talking about blue chip, you're talking in the US, it could be at least $10 billion and above. So blue chips, generally speaking, are companies which are mature. They have been around for many, many years. They have a pretty good, reputation. People sort of know them. You have a very sort of a familiarity with the brand, the logo, and everything. And they have been making some money along the way. Generally speaking, it sort of there's this safetiness to that long track record of profits. So in a nutshell, that's a blue chip.
Yeah, so why blue chip?
I think it comes from the term in poker. So it came from there. Yeah, it's the blue chip always represent the highest value. It's the biggest chip. So like what Willie said, it's probably one of the biggest industry name there.
Beyond the definition, I think the assumption here is that these companies are big and strong, right? They've been around for a long time, and there's some assumption around like they will not collapse. They are stable. They are safe. They may not grow a lot, but they will give you good dividend. That's kind of like the street's understanding of blue chip, right? When people use it very loosely, they are not going to look at the market cap. So this is 900 million. No, not blue chip, right? So I think there's some assumption there? Is that a fair statement? Any other thing you want to add?
Blue chip actually does give some capital gains also. So I think really looking for the undervalued blue chips. I think because the common people out, it'll be kind of boring. You'll think it's actually a bit boring, but actually if you really dive deep, I think you can actually really find some gems in the blue chips.
But Chun Ting will tell you boring is good. Investing must be boring long term, 对不对?
Right.
It really depends. It really depends on the age group that we see. So yeah, some excitement in the investment makes you feel alive also.
Okay,
Yeah,
okay.
for me personally.
But statistically, is it accurate? From your point of view, maybe you can expound on that a little bit. I think it also adds onto a layer where the Singapore stock market has been quite lateral, for a while. You see a lot of retail investors, even the more sophisticated, even more sophisticated one probably invested in the US or invested in other markets, right? So capital have moved, and you see a lot of retail investors that are Singaporeans, they invest in the Singapore market, and it's just like not really moving much, right? And they end up having to like really dig deep and pick some winners, within the market, right? So I think those are some of the real concerns of the people lah, right?
Yeah, that's true. But I think for investment, you do have to put in the hard work also. I mean, nothing comes free and easy. So the more work you do, the more gems you can uncover. Then I think you take that sense of ownership. And if you really get it right, you could potentially get some multi-baggers even.
In the Singapore market?
For the past few years, not that really, but you can actually see quite good gains. But I mean, if you look at the banks, you're up like 40%. So if you're really analyzing it, buying it when it's undervalued, I think you do still see very good value.
I mean, just a personal anecdote myself. For me, I've been investing for over the last 14 years. And one of the blue chip which I actually bought, surprising, and I think a lot of people might disagree with me, is actually Singapore Exchange. I've bought it when it was about $6, around $6 per share. And yes, shares have sort of slightly more than doubled since then. And what's interesting is that for this kind of blue chips, they have been around for many years, like I mentioned. They have been paying dividends, and they've been very consistent with their dividends. So there are a couple of stuff which we want to look at when we are assessing blue chips. I mean, of course, not all blue chips are the same, right? There's always a spectrum of the good ones and the bad ones. But what I'll say is that for blue chips, I always like to think of it like a flying elephant. So if that elephant can actually fly,
The elephant can fly. It's called Bambi.
is something which is that's something which I want to be looking out for. So that's where the uniqueness in blue chips is.
So that's why you are biased with the Singapore market. I own the exchange, so the exchange is good. Singapore market vibrant.
I really hope that they do something well. So, and for me, look, I always have a bias, right? When I buy something, I do have a bias to what I buy.
So to be clear, is it a fair statement to then say that, when you enter these type of blue chip stocks, you're really expecting marginal capital gains? Like there is some, sometimes you can find a few good ones, but often the gains are not amortized over a decade. It's not significant, at least in the Singapore market, but you are really getting the stability from the business, which then derives the dividend. Is that kind of the assumption that people should have when they come into the blue chip investing space?
I think generally that you go with the assumption. Like I mentioned, is when do you buy it? That's one of the key critical point.
But you cannot broadly diversify, right, in the Singapore market in that sense. You have to pick from your point of view.
I also own some Singapore stocks. And I think that's actually, I describe it like that, but that's actually one of the issues when you come to stock picking, like when do you sell? So you actually suffer quite a lot in trying to decide what are you actually doing with these things. I'm probably a little bit even more, some would say, extreme or purist when it comes to diversification. To me, 30 stocks doesn't do it. I'm talking about like the world. And this is really more view that where we can get the reliable returns is where there is this underlying logic that, enterprise and companies drive growth. And I can't tell whether individual markets will be able to do that. I can't tell whether individual stocks will be able to do that. So it is safe and reliable in the sense for me to depend on the global economy over the long term. Yeah. So to me, broadly diversified means, or even like passive investing, actually means having a big enough base, like a big enough basket of food, right? So for me, broadly diversified means global diversified. We're talking about thousands, right? So some people think that diversification or passive investing means I invest in an ETF or invest in an index. But this ETF can be about one sector. This ETF can be about one strategy, and all that. So broadly diversified means owning the world, owning the best companies in the world. And so I always own the blue chips of the world. Singapore market is very small. And I think we have got a lot of discussion about supporting the Singapore market because of the lack of liquidity. And like it or not, lack of liquidity does affect the performance of the market because it's price and all that. But I can understand that blue chip investing, largely what you said, I'm not sure that the blue chip investors would say that they only got marginal capital gains because I think there can be quite significant capital gains. And I think over the last year, say DBS has stood out, right? And DBS is one of the big ones. They may not get the fastest growth, like your Nvidias and all that, right? But they also may not have very big drawdowns, or maybe even if the big drawdowns over the long run, they are stable and they're here to stay. And dividends does seem to be one feature of many of these blue chip stocks. 20 years ago, 2 decades ago, so where investing globally is not so common or not so easy, to access. There are strategies, the uncles and aunties, right? They have built wealth through investing in Singapore blue chips, right? Those who bothered to, rather than and not be so risk averse. And so they say they buy this basket of stocks, and they collect dividends, and over a long run, they also manage to get some capital gains. The question is this a viable strategy? I think it can be, but it's contingent on a few things. It's contingent about doing the homework, contingent about on things not changing such that the blue chip no longer blue chip. So during those times, right, people say, you buy SPH lah.
Just to be clear, Singapore Press Holdings, sorry. But because at some point the property income was so big, so the joke was it's called Singapore Property Holdings. But anyway, yes.
So at one point, I would say that was considered a blue chip.
I think so. Yeah.
Then buy Singpost lor. Then all that, then buy Singtel, and I mean Singtel is probably still in that list. I mean that's the idea. That's the idea, right? And then you get dividends, and I still remember in those days, SPH always about $4 lah, but then you get dividend lah. Doesn't go up very much, but what happened is that there are big trends, and there are big trends that can then make you have to assess whether your blue chip is continuing to be blue chip. And I think all around the world, we do see that companies, individual companies, can suddenly fail. That's why I favor sort of diversified investing as a core, because I think that unless you are able to catch that and able really to pick those stocks consistently, there is a concentration risk, no matter what it is. You have to do so much work, and then you pick these, and then can you get it right? And so I feel that there is that risk, and so it may not be as safe as it seems to be.
Just to add on, I think it's about the blue chip whether able to adapt to the surroundings. I mean, you can see a very big AI push, and we have to access whether our own Singapore companies are they able to tap on that.
So is AI
innovate?
like the biggest trend disruptor? Because what Chuin Ting was saying is like there are big disruptions, right? And then it just killed some of the. And it's not just a Singapore stock thing; it's across the world, right? So other than AI, are there other trends that you're observing that you think could be a significant disruptor to some of the blue chips here, the top 30s around?
I think mostly is the AI is one of the biggest push, and then the quantum computing also. So this is all along that line, and whether management is well equipped, or do they have the foresight of having to turn around or get into that space as soon. You can see that today, like, Donald Trump and all is coming up their Stargate, really moving towards that area. So it's our blue chips doing that also, or they just resting on their laurels and just doing business as usual.
I'm not tracking the blue chip very tightly, but for vaguely, right, Singapore blue chip left property, finance, some connectivity guys.
Oil
guys, that's about it, right?
But actually you made a very good point. If you look at the STI 30, actually they're all what we call financials.
Yeah.
Right? If you go to the Bloomberg machine, you say actually it's all...
they pick up.
Not just that, the property as well, right? Because, and then that goes more or less in tandem, the same cycle. Yeah, so that's a bit of concern, because it means that in certain cycles, they are all, they might actually be quite correlated.
In Singapore, it's a couple of sectors here. After the oil and gas, offshore marine sector blew up in 2014, 2015. There's a couple of sectors left. But if you just zoom out to the global stage, right, you'll see that countries, Singapore is positioned very differently, because it's a lot like Hong Kong. Hong Kong, it's a financial hub, and when you have a country which is a financial hub, only a few sectors would really prosper, because you are just a hub for wealth, for instance. So naturally, sectors like telecommunications, oil and gas, used to be oil and gas, properties, financials will naturally dominate the sector. I mean, if you look at the Hong Kong market,
Yeah.
it's roughly the same kind of makeup as in Singapore, because Singapore doesn't really have the kind of hinterland. And if you look across the neighboring country, Malaysia, mostly they are manufacturing
A
companies,
lot of, yeah.
consumer-based companies, but we are in no position to compete. That's why what's left generally is what I call, Darwin likes to say this, survival of the fittest. So you are naturally left with a couple of these sectors, which might not be a bad thing, because if you then only are left with a few sectors, then you just focus on trying to find the best of the best, in my opinion.
Okay,
So
okay.
from there, then you sort of sieve out. And that's where, in my personal opinion, the Singapore market really, really shines.
Fair.
Of course, if you try to sort of move out of that circle of competency and you try to say, okay, I want to try to find the best manufacturing companies. I mean, you have to be honest with yourself. You're not going to find the good ones there.
Sorry,
as compared
it's not
to
here.
the US or Malaysia or even Indonesia as well.
Maybe, hopefully.
I mean, if you look at the last 10 years, ASEAN companies, most of the ASEAN growth, be it consumer companies, are not coming from Singapore. A lot of it is coming from Thailand, from Vietnam, from Malaysia as well. So we have to understand as investors, because Singapore is considered a financial market, it doesn't mean that it has all the different sectors it can offer. We have to be selective about it, and we have to be smart about it when it comes to investing.
Actually, concentration is not unique to Singapore market, right? If you look at the global market, and even when it comes to passive investing or S&P 500, is actually only driven by, the performance is usually driven by a small percentage of companies. And in recent times, even more so. So they were saying that if you, from the US, you took away the Magnificent Seven, actually not very magnificent.
Not very
at all.
magnificent.
Yeah. But the difference is that when you, so I do have a question, whether blue chip companies are actually the bigger ones or the smaller ones, because you talked about value investing, right? So that's, I think maybe Willie can share with us on that. But the difference in passive investing versus, say, picking the stocks is that in the passive investing, the companies take turns to be the top ones. And so you sort of let the index sort of take care of that, and you sort of ride on whatever people are investing out there, because most of these indices are market capitalization indices. Yeah.
Maybe you can share a little bit of like your biggest wins in the SGX market so far, other than SGX itself, lah. Right? I mean, that kind of provides a context, right? We're not trying to tell you, buy this is definitely good. No, right? It's just kind of like providing the story context as to what are some interesting things that you guys have invested in over time, and in SGX that you find can withstand the trend disruption, withstand all these problems around the world. What's your winner and could continue to win? Maybe you can share some of these things. I know you came on the show previously. You talk about the whole REIT thing. Go and check out the episode, right? We had a whole discussion about REIT because he did a whole research around it, right? Like, is it still online? Your
Yeah,
research?
it is.
Okay,
Of
yeah.
course,
you can go and download dividendtitan.com. Yeah, I heard you plug, okay? No paiseh, okay? Yeah.
Before talking about winners and losers, I think to answer Chun Ting's point, I think how I see it, investing, I think value investing encompasses the general idea. For me, it's always trying to buy assets at a discount, and that's the whole idea of value investing. And dividend investing is actually a subset of it, because you don't want to be buying dividend stocks or companies where they are very expensive, because you could still lose money on them. There are dividend paying companies which, even though you invested, might have lost you money. So I would say value investing is probably an umbrella of investing in general. Having said that, this term has also caused me to lose money.
Value trap.
So in Singapore, I did mention about me investing in Singapore Exchange when it was about $6 per share, but I also have made losses investing in commodity companies, infrastructure-related companies. So one example would be HiFlux a couple of years ago, and I bought it on the basis that it was expanding really fast in the Middle East until the Libyan crisis hit. And that started shaking up the entire business. I did expect the fundamentals of the business to actually crumble very fast, because back then I was still very new as an investor. That actually lost me a couple of $1,000s or tens of thousands of dollars back then. And I could still remember that time when I was reading the news. I was actually in China. And when I read the news, I was, just surprised that how can, well-reputed businesses would lose very prolific contracts. So that opened the doorway to thinking deeper into what this blue chip really means. Like they might, like what Kelwin say, blue chips means business of the highest value, but they do have some cracks, and it's up to the investor to actually look through at some of these cracks to find out, whether they are truly worth investing or not.
And that's a big part of the whole value investing idea, right? You think the market has mispriced this thing a little bit, and too ahead of its time. Then you try to kind of see, you build a thesis around it, you work backwards, and then you make a decision on it, right? That's a big part of what it means, right? Okay, so now what's the winners?
Say some more.
Yeah, maybe Kelvin, you could share some. I mean, both of you are more in the space on these things.
I gotta be guilty. I'm not fully invested into the Singapore market. For Singapore market, I'm more into the REITs.
Yeah, it's okay.
So I
you can
think
share.
that has been just collecting passive income. So only around about 20% of my pot is in Singapore. Yeah, the other 80 is a little bit more higher risk, I would say. Yeah.
Hey Coconuts, I'm very excited to introduce you to the latest offerings from World First. World First is an all-in-one business account that fuels your business worldwide. Their latest product, the World Card, is a multi-currency business card that allows you to get unlimited 1.2% cashback on all your business spend. If you use it on Meta Ads, Google Ads, ChatGPT, Salesforce, and more, you get additional benefits. Of course, subjected to change, terms and conditions apply. But more importantly, if today you are looking to start your business, whether it's in retail, e-commerce, or B2C, World First is your partner. Check them out, link in the description below, and back to the show. Just to be clear, you guys don't see the REIT as a blue chip, right? You see the REIT as a separate category, or you think REIT is a subset of blue chip?
The blue chip of the REITs, maybe.
Because in Singapore, it's 20% of the market cap, right? So these REITs are quite serious in the game.
Oh, I looked through REITs. I definitely would consider REITs as part of a blue chip as well. So that means when I talk about blue chip, I also include REITs.
Okay. But the mechanics is a bit different, right? Because for a 40% gain, maybe it's not marginal, 40% gain over a decade. Not okay, Chuin Ting said not marginal, not bad, huh? Okay, so if even if it's not marginal, it unlikely will happen in the REIT market, right? Unless the recent correction in that sense, right? So without that, the kind of fluctuation in the REIT market is not as huge, Is that a fair statement? Or you think like, oh no, there are crazy ones around?
But at the same time, if they're crazy and you need to know why are they crazy, is it a change of management or is it some geopolitical kind of thing? So yeah, if it's maybe like prime REIT, yeah, it went down quite a bit because the offices in US were getting hit. So that kind of REITs you might want to stay clear.
Yeah.
So that could be the reason. So you really need to dive deep into why is it having such deep correction as compared to the other REITs.
If I can offer a perspective, blue chips are quite often used for what Kelvin was mentioning, passive income and dividends that come out of it. So what is the psychology of dividends, right? Actually, dividends are just a feature. If you think about it, dividends, company will declare dividends, or company can reinvest earnings into growth. So why is it that people like dividends? So there are some things around it. And when it comes to REITs, right? So I have good friends who they will not take the volatility in the S&P, right? Even though I say you're investing the whole world and over time the stock market always goes up. But then the REITs can tank by 30%, 40%. Then they said, no, it's okay. Sure can one, sure will go up. I just collect dividend. Then dividend very high. It's like, because the base price dropping, so dividend very high. It provides a feeling of safety. If this appeals to you, then let me find the best, what to me might be a second best solution, that you can't, that it helps you stay invested, right? Then the issue is that how do I construct a good enough portfolio such that you have a very high degree of reliability in getting. So dividends do give you that sense of reward as well. So from a psychology point of view, like, okay, you are being rewarded by the dividends.
So if I push your discussion there a little bit, right? Does it mean that the feeling of safety is misplaced?
Is it a little false sense of security?
Yeah. Is it a false sense of security?
The thesis is that eventually the capital side will be there.
Okay.
Will come up, right? Ultimately, in the US, if you analyze the dividends contribution relative to momentum and all that, actually it's done quite poorly over the last year. So that's why dividend is just a feature. So this friend, he collects dividends. Actually, he doesn't need, he earns very well and he's got bonds. Then he keeps thinking, how do I redeploy all my cash? How do I redeploy all my cash? I was like, you don't just let it be. But I think it's really that sense, whether it's false or not, ultimately it is the underlying return. In investing, very important concept is total return. Total return is basically your income and your capital plus or minus, right? And in order to get the long-term return, you have to stay invested in the asset class. The dividends seem to help many people stay invested. Yeah. So I really wish that this approach to REITs can be expanded to globally diversified investing, then my job will be done because because a lot of time
my mission is complete.
Yeah.
Before we go to the US, right? I want to end the discussion with the US blue chip versus Singapore blue chip, how they're very different. So I want to end there. But before we go there, I think there's also a whole pursuit. So if we assume that there will be some capital gains if you pick the right ones, but there's homework to be done. But I think more likely you see a lot of dividend growers, rather than serious big business growth and capital gains, in Singapore. So the other day we had Arthur from Singtel came on the show to talk a little bit about their plans to grow their dividend and the whole thing, right? So that was a good episode. Would like to kind of hear your point of view of how do you then spot, or what are some characteristics of a dividend grower in the Singapore stock market?
First of all, I think we can understand what sort of returns we are looking out for. Some of us might be just comfortable with a Toyota Camry, just driving a Toyota Camry, which is pretty safe. It's pretty decent. Whereas there are others who might want to do a Ferrari, which can be higher risk, but you kind of get excitement. So I think it all boils down to your own personal choice. Having said that, I think for dividend growers in Singapore, I think I will still use the kind of same lens which I use when I'm investing in dividend-based companies. So the few questions which I'll ask myself is whether they have a very strong competitive advantage. Do they have a durable economic moat, and whether they have what you call very habit-forming products and services. So what do I mean by this is, are these companies selling products and services where they're able to raise prices and still attract customers to come back to use it over and over again? And if they're able to do so, then I think it's worth considering looking at some of these businesses. Why? Because when they're able to raise prices, it means that they make more money. And more money means that they're able to increase the dividends for these investors. So this is what I term dividend growers. And there are companies, whether it's in the US, in Singapore as well, we just have to sort of dig a little bit deeper to actually find some of these companies. If you just zoom out from the broader picture here, what you're ultimately trying to find are the businesses where they are also able to efficiently use their capital, right? So if they are able to, let's say, invest $100 back into the business, how much profits can I actually make from this investment? And as an investor, we want to put on the thinking cap of being able to find these businesses where they are efficiently using this capital. And that's really the rocket fuel for trying to find some of these dividend growers. And that, personally is like my basis of approaching some of these blue chips.
I think my audience will not let me go past if I never ask, where are you fishing? based on this parameter of thought, right? This framework, what is interesting to you at this point in time? Once again, this is not financial advice. We're just having a discussion of okay, what is interesting to you? And it's not even saying that Willie is definitely going to execute trades or anything. It's just where is he looking at this point in time?
Must it be in Singapore only? Or?
No, don't need. We can use it as a platform to shift out of Singapore already. But yes, please share with us some thoughts based on this framework, right?
So I personally invest in 3 main markets. Singapore is definitely one of them. I also look into the US. I look into China and Hong Kong as well for dividend growers. I would say where it's interesting right now, to be honest, for me, I'm always a bottom-up investor, meaning I look for opportunities where the fundamentals of the business is right for me. So I don't really bother too much about what's going on with the elections or interest rates, even though I do try to keep up the news. In US, I think what I like are many of the consumer stocks which have been heavily beaten down. Reason why is because everyone is expecting inflation to stay high. They are not ready to take out their money to spend, right? If you're thinking that, hey, things are going to get very expensive, what I'm going to do is I'm probably going to put my money in the bank and probably just wait it out, or just collect interest rate from the deposits. So because of that, a lot of consumer companies, the share price have been heavily beaten down. So you're talking across the board with cheap products, for instance, discounted products. You're talking about high luxury items, which have fallen off the cliff. And I think that's where the opportunity lies. And if you think about it, I know this is something where people, it's pretty well known, but I'll say it again. Warren Buffett invested in Coca-Cola in 1988. And back then, Coca-Cola was still considered a blue chip. So the misconception is that people think that, hey, Coca-Cola as a blue chip, it can't really fly anymore. But since then, it has compounded huge returns for Berkshire Hathaway, and it has set in the top 10 position of the company. And on top of that, so this is where things get more interesting. It's Coca-Cola's yield, or Warren Buffett's yield on his purchase of Coca-Cola in 1988 now sits at more than 50% dividend yield on his initial investment after Coca-Cola stock split, after Coca-Cola's dividend growth. So I think what's important here when we are looking at dividend growers, I think fundamentals is important, but also we have to understand the mentality of investing. And I do like what Kelwin and Chuin talk about investor psychology, talking about having that long-term outlook when it comes to investing.
If I have 50% dividend yield, I will put the drink here every day. Every single episode, I will feature it. Okay. but yes. But it's really about the price you enter at and letting it compound over time, and the dividend grows, right? So it's not like you can buy at 50% yield. If you buy at 50% yield, chances are there's some problem in this company. so right, you kind of ride with it, and then at some point, I mean, some people's DBS stocks and all these stocks are yielding them teens, 20s, year on year. Of course, they're very happy, right? Singapore one way, right? So it really depends on like the price point you enter and the kind of growth over time.
The funny thing is that Warren Buffett actually advised that maybe most of people should just buy. There's only so many Warren Buffetts, right? And it's hard to consistently get it. And there's a lot of mental accounting when it comes as well. Another part of investor psychology, right? So, you will have people who tell you that I bought this stock and then it went to, or so and so bought this stock and went to what, But then if you look at it from a whole portfolio point of view, yes, they might be keeping like 80% in cash. So if you versus, actually most important thing is that how much are you staying invested? If you then say, okay, but then some maybe got minus 50% still sitting there. Those stocks that go down, you don't sell one, right? But of course you can say, I'm happy to do this. And that's why sometimes I feel that blue chip and value investors, actually they tend to have quite a lot of cash because it's like, it doesn't really matter, and so they are already quite well endowed, and so go ahead because you don't actually need to take this risk. That's why when you see fund managers and why they underperform is because they don't have this luxury of saying that hey, I just want to tell you about my winners, I don't need to tell you my losers, right? It's because they have to be fully invested, and cash is a drag. Yeah. So I think it's just that it's great to understand stocks, understand the economy, and love stocks and all that. It's just that how much would you put into it and put into the ability of be it yourself or your advisor or your fund manager to be able to consistently do it. I'm not saying that advisors and fund managers don't try their best. They really, really try their best. It's just whether it is possible to be consistently doing it for 100% of your
Cash is a drag. Sounds like a great tagline. Cash is a drag. But it's true, right? Technically, right? Yeah.
It's a technical term because in fund management,
it's true,
right?
Yes.
So last time when I was running investments at institutional level, then people, you keep 5% cash. I'm not happy, because to me it's like I'm paying you a management fee. You give me back lah. Give me back the 5%. 5% is about maximum for me. When it goes to 10%, like please, because this is all a wasted return, because time in the market is very important.
In closing, maybe any last things you want to add, relative to the foreign markets, and the Singapore blue chip, how is it? Are there any similarities or differences, or something to look out for, so that we provide context to our audience based on whatever we share? Does it apply in other markets? Just to round it up.
Diving deep into the fundamentals, I think like what Willie said, I think that's one of the key importance. I mean, for the clients, you can't just smoke them. You need to understand what you're talking about. I think you need to have that high conviction also. So I think like most blue chip will work if you've really done your homework, like ROE, whether there's a consistent positive cash flow, all that stuff thing, whether there's a growth. What's the growth going to be like for the next few years? Because if your growth is stagnant, you probably won't see that kind of a big jump in the price. So I think all this has to be really taken into totality before we want to dwell or dive into that stocks.
So you would say that's consistent across the board, regardless of where you're picking your blue chip?
Yes, I mean, with your own criteria, I think you have your own set of criteria. Of course, you have to double check whether your thesis makes sense, and you've been going through this has it been giving you the returns that you kind of are looking for? And do you need to switch around? And like you said, there's a lot of tools on the internet which I use. But of course, sometimes there's just too much. So we need to just narrow it into a few, maybe 5 or 6 criteria, and keep on repeating that in the industry. And of course, how relevant it is in the whole macro environment for the company.
You got any other things to add?
I think as investors, for me personally, I always like to look where there are opportunities, and I try not to pigeonhole myself. So I try to expand and try to see where are some ideas. It doesn't matter. Geography doesn't really have. It doesn't have to confine ourselves by a certain geography. I mean, Singapore government says that we should actively go out.
So the capital also should go up.
So the ideas should also go out, because we shouldn't be cocooned by what we are seeing here, right? It's good to venture out. So it's not just capital going out, but the ideas should also be going out.
Of course.
And I think that, to me, allows us to better evolve. I mean, if you look at Warren Buffett, all right, he started off as a special situations investor. He wasn't the kind of buy and hold investor he is today. And he used to be buying companies where they are just, cigar butts. You basically take one last puff from the cigar, you throw it off. So he has been investing in all this kind of business to make his first million. But later on, he evolved his strategy from special situations to becoming a buy and hold investor to investing in big blue chip companies. And I think he can only do that if he go out there to talk to people, to sort of see the world. I mean, back then, it's probably the different states in the US, which gave him different insights. And I think that really would help us as investors.
Yeah, last words, other than broadly diversify, I give you the last word. Any other thing you want to share to the retail investor out there?
Some of when Willie was describing what he does, it really reminded me when I was in fund management, crunching these things. And I joined the fund management industry in 2007, and I was a bank credit analyst, so global bank credit analyst. So the blue chips of the day, Citibanks and all that, they were mine. And it's really not easy to have seen this coming, right? I'm talking about 100-year-old companies and all that. And when you crunch numbers, or when you look at numbers and out there, right, the question is how much of it is actually objective and how much of it is actually also based on forecasts. So we talk about, say, PE ratios, right? So valuation, you like to buy at good value. But the most common PE ratio that is being used is not the trailing PE ratio, it's actually that E is a forecast. So then everything depends on the forecast. And when analyzing on the stock side, one of the main things that we use is the discount rate, right? Discount rate. Now, I just need to change the discount rate a little bit, and then the growth assumption a little bit. And just mathematically speaking, it all goes off. So that's one thing that I think is a limitation, because ultimately a lot of fundamental analysis, you still need to make many, many assumptions. And some of these are macro assumptions. And macro is very hard to predict because, equity risk premiums, interest rates, and all that. So I think that's the first point, that you have to find a system that works for you, and you have to be intellectually honest whether it really works. Not just whether it works once, whether it works twice, but overall whether it really works. And I think I like what Kelwin said about your thesis. When it comes to high conviction, the danger is that you hang on to it. Hang on to it that because you have a sunk cost and the pride and all that. I think the second thing is that unfortunately the markets can sometimes not reward in terms of price movement, especially in short term, good companies. Right. So if you talk about, say, in US, let's say Qualcomm, right? Qualcomm during the time when it was growing, it's not management's fault, It's nothing that earnings really go up, but then the price doesn't go up. Yeah, so you don't know sometimes what's going on. Perhaps I would like to suggest that there may not be like really a correct price that the markets go towards. It's just the markets just do what the markets do, because there's a lot of other aspects. Yeah. I think the most important thing I would like to convey to retail investors and all that is that do look into investing. Okay, there are various ways of investing, but I would like you to protect yourself psychologically if you are a beginner, right? So the worst thing is not really whether you active, you passive, you underperform. But the worst thing I've seen is that people get burned in stocks and then they don't do it ever again, right? And that's when I think you have to invest in your own financial literacy, and you have to start where you're comfortable with, And that's very important because a lot of investing is psychology. A lot of investing is strength in that ability to know what to do and what not to do, so that you can benefit from the long-term rewards of above inflation return for your goals. Right? So you're not here to win the Stock Picker of the Year award. You're not here to be the Fund Manager of the Year award. So that unfortunately, some of like Kelwin might have that occupational hazard.
Yeah,
Right?
industry
Yeah,
requirements.
and you're just there to. You're not here to beat the market. So you're just here to make sure you hit your goals, right? And so just go for what really works for you, a philosophy that you can stick with, so that investing becomes part of your life and for everyone. Yeah. So I think that's what I would really like to see in Singapore for that maturity and the investing, the financial literacy and the financial capability of Singaporeans.
Nice. So stay tuned, moneyhour.com. You can see what's up to next. Okay, so that's it for today. Thank you for your time spent with us. And if you have any specific question, you can put it in the comment section. You can engage them on their socials. And most importantly, head to www.financialcoconut.com. Put your email there so that you can stay updated about what's episode to come, what are the events to come, and all that good stuff, right? So yeah, stay connected. We'll see you next week. And with that, bye-bye.